Whereas Chapter 2 focused on the balance sheet, Chapter 3 focuses on the income statement. It starts off with a discussion about the operating cycle. The operating cycle, or namely the operating activities within the operating cycle, are the primary sources of revenues and expenses. And as we know, revenues and expenses make up the income statement. Essentially, the activities within the operating cycle encompass the time that it takes for a company to acquire goods and services from suppliers or vendors, and then ultimately turn those goods or services into goods or services that are sold to customers and ultimately collected for cash. Key portions of these operating activities are ultimately going to be shown on the income statement through revenues and expenses, and those are going to be our focus for today. So in focusing on revenues and expenses, it's going to be really important to determine what drives the transaction being recorded, and ultimately that's going to lead us to a discussion about accrual basis accounting, which is what we're going to focus on right now. In determining when to record revenues and expenses, you can say that general accounting offers us essentially two choices. We could utilize what we refer to as a cash basis accounting, or we could utilize what we call accrual basis accounting. Ultimately, to cut to the chase, I'm going to tell you there's only one acceptable method under financial accounting rules, and that's going to be accrual basis accounting. But it's important to distinguish between the two so that you understand how accrual basis accounting works and avoid any common pitfalls that students sometimes run into by thinking along the lines of cash basis accounting when attempting to actually do accrual basis accounting. Okay, the important point to know about cash basis accounting is that revenues and expenses are driven by cash. Again, we're not that creative coming up in names in accounting. So it's cash. Cash coming in is going to be revenue. And again, this is from the company's perspective. Cash coming in is going to be revenue. Cash going out is going to be expenses from a cash basis perspective. From accrual basis perspective, that is not the way we interpret revenues and expenses. Instead, revenues are going to be driven by what we call the revenue recognition principle, which we'll talk about here in a minute. And expenses are going to be driven by the expense recognition principle. And again, we'll talk about that here in a minute. It's important to note that revenue under an accrual basis accounting is not necessarily cash. It could be related to the timing of cash, but it doesn't have to be. The timing of when cash goes in or cash goes out is separated from revenues and expenses being recorded on the income statement under accrual basis accounting, as cash basis accounting is completely driven by the timing of cash receipts or cash payments as it relates to revenues and expenses. You could say that the ultimate goal of an external user with financial information is to determine whether or not a company is going to make money in the long term. Keep in mind that the goal of financial statement information is to be usable to the decision maker. And so ultimately, if we're trying to predict whether or not a company is going to, in the long term, be cash flow positive, the financial statement information in the short term have to help us have that predictive or confirmatory value when a financial statement user looks at the information. The problem that we run into is that while our goal is to determine long-term cash flow from a company, we must use short-term information in order to confirm or predict that long-term outcome. And cash basis accounting in the short run does not do as good of a job as accrual basis accounting in giving us that predictive value. Your book gives us an example of an app development company who also provides consulting services. They look at the situation where consulting services are provided in one month, but then are paid for in the following month, meaning that the company sold consulting services, but doesn't receive the money of providing those consulting services until the month after the consulting services are actually done. In this instance, if we first go on cash basis accounting, notice what happens. In this first month, we pay our workers to provide the consulting services, so cash goes out, but we don't actually receive payment for the consulting services that we provided because those services are provided on credit, something very common when you have business-to-business transactions. And so our income statement essentially, remember revenues minus expenses and net income, essentially it shows a net loss in the first month of $10,000. Notice then what happens in month 2. Assuming no other services are provided, we get paid in the following month $15,000 for the consulting services that we provided in the last month, have no other expenses because we assume no other transactions took place, and we show a positive net income of $15,000. So in month 1, we have a loss. In month 2, we have a profit. But understand what we're trying to do as an external user of the financial statements. We're trying to use information that's historical, like for instance, month 1, to help us predict month 2. But notice on a cash basis perspective, because businesses often operate with credit, we can't do that, or at least we can't do it as well. But if we utilize accrual basis accounting, which separates revenues and expenses from the timing of cash, we can actually better predict the long-term cash flow of a company, which is our ultimate goal as an external user. In this second analysis of the exact same information, but this time using accrual basis accounting, where this previous one uses a cash basis accounting, we can see that we're able to match the revenues from providing goods and services with the expenses or the costs it took to provide those goods and services. Notice that even though cash was not collected until the following month, we still record revenue under an accrual basis accounting in month 1 because that's when the performance obligation or the goods or services were provided to the customer. And then the expenses that it took to provide those goods and services are then matched with those revenues in the same month, thereby showing a net income that has more usable value that we can then predict in the future. Now again, assuming that there's no other transactions in month 2, we wouldn't be able to use this to say, oh, month 2 is definitely going to be 0. But what we would be able to do is use this information to say when services or goods are provided, this is what we should expect as the net result. And that's why it has more predictive or confirmatory value. But if we're not using cash in order, or at least cash timing, in order to determine when revenues and expenses take place, you might be wondering, how did we know to record the revenue or the expense in that month 1? And that's where it leads us to a conversation about the revenue and expense recognition principles.